3, 2, 1.
Alrighty.
Ready for
There we
liftoff.
go.
I wonder
Liftoff.
if how many people actually get that whole 3, 2, 1 reference.
Yeah.
Jerry and I had a don't judge me by my current state of fitness.
Yeah.
But we used to own a CrossFit gym back in the day, and if you look behind me, there's our old logo, CrossFit and Pavas. But anyway,
That's right.
if you are a CrossFitter, like for
3, 2, 1, go.
3, 2, 1, go was always
Yeah.
like the way to start a workout. Anyway, it's just held over from me. Doing that about 1,000 times a week with coaching workouts and doing whatever, saying 3, 2, 1, go.
Those were the days, bro.
I don't want to go back to them.
No.
If anybody's interested in or thinks they're interested in building and owning a gym or anything like that, good luck, bro. Man, that was the hardest I'd ever worked in my life. We did it while we were still govies, and man, 5 a.m. classes and 7 p.m. classes, and we had a lot of help, but man, it was a lot of work.
A lot of work.
Yeah.
Good times, though. Good
Anyway,
times.
I digress.
All right. So, another crazy week for the market. So let's see what we got. TSP Weekly Podcast, 22 October 2023. Do a quick slide on some of the things that happened that were interesting this week. And then we've had a couple of questions on this idea of share price and why don't we ever talk about the share price of the TSP funds. And so we'll kind of get into that. And then deciding on fund allocation percentages. I got a question about, do you guys ever, if you get a sell trigger on one fund, would you sell? And basically it comes down to trying to figure out how to do your allocation percentages. So I'm going to talk through that on a couple of charts. Bonus chart is going to be TAN, which is actually an ETF of solar companies, and then TSP fund charts. So earnings season started big time this week. Started out actually pretty well at the beginning of the week with Bank of America, Goldman Sachs. The banks did pretty well. Tesla missed big time and is pretty much tanking this week. United Airlines is tanking. So it's kind of a mixed bag, I think, at least for the first part of earnings season. The administration comes out and eases sanctions on Venezuelan oil, which the idea was to kind of free up, kind of take some of the wind out of the sails of rising oil prices. And it does not seem like that has had that effect, at least not yet. Oil prices are through the roof. And it kind of goes along with inflation. We got a second carrier battle group going to the Med. That, of course, is not a good thing. There are Marines on carrier battle group, and as much as we do jumping jacks about how we're not going to have boots on the ground, we don't. We have boots on the aircraft carrier until they go to the ground.
Yeah.
United Auto Workers strike. That again is a big inflation play. Whenever they resolve that strike and they get new contracts with higher wages, that just goes to drive up the inflation number. And then this week we hit, I think it was Thursday, the 10-year yield hit basically 5%, 4.989%, so 11 basis points off of 5%. It is an unbelievably high 10-year yield, and that's going to eventually force mortgage rates to be over 8%. If they're not over 8% next week, I'd be amazed. And we'll see if that has any effect on the housing market. So inflation just keeps going. World events are bad and getting worse. And so the bottom line of all this is while we kind of focus on the charts of the individual TSP funds, the backdrop of all this is not good.
Right.
If you're a long-term buy and hold, I'm not doing anything. I'm staying in CNS for the rest of my life.
It's scary.
You are absolutely not paying attention to what's going on.
You got your head in the sand, and and we hope not, right? That's why we hope you're watching the show. But one of the things I want to point out about the things that Jerry has on that slide, though, also, is that those are the things that happened this past week, and they're nice to know now, but you don't know before they happen, right? And so we've been talking about this, or at least I've been talking to myself about this a lot this week. We haven't been together as much this week, but we've both been working on different projects, for this. But the just the idea that, it's all baked into the price, right? And that's what you have to just not necessarily just assume, you have to accept, right? And most people in the industry would accept that. Like it is what it is. That's the price.
Right.
And sometimes the price doesn't reflect what you're watching happen in the world
That's
per
right.
se, because investors can choose to do otherwise, or they might not have completely digested all of the things that are happening, and it's a lagging kind of effect.
Right.
Meaning, like plenty of people would say this week, if you were watching all the different talking heads, that the market did not react the way they thought it would, right? It's still kind of giving a lot of hope in there.
For sure.
It's popping up a little bit. It's, we're a little bit in the market right now, and I mean that's the reason, is because you can't ignore the fact. You could look at all of the doom and gloom macroeconomic indicators and the larger kind of price charts that say we are probably headed to a massive downturn.
Yep.
We don't know, but everything's telling us that. But that doesn't mean that the market might give you a couple of weeks of goodness.
Right.
And so do you ignore that? Or and there's nothing wrong with, ignore is probably the wrong word. The decision, I think, that particularly, because again, what we're trying to do is educate you guys, is the decision comes into not do, should I be in the market or not be in the market? What can your circumstances, your personality accept?
Yep.
Right? There's a lot of turmoil going on. If you don't do well with turmoil and you really don't want to be invested in the day-to-day churning, then it's best to sit on the sidelines and take your 3 to 5%.
Yep.
However you want to calculate it, however it ends up being by the end of the year. But that's okay. There's nothing wrong with that. We tend to be here's the funny thing is for so long, at least 2 or 3 years that we've been doing this, we get so many people tell us that we're so conservative.
Yeah.
And I'm like, really? Like anybody that's even slightly in the market right now is not conservative, right? What we do is respond to the price. If the price is going in the trend upwards, we want to be in there. And sometimes you can't take advantage of all that as well as you might in other places because the TSP has these constrictions, right? And so I always caveat that so nobody forgets that, yes, we're trying to be active. We got the 2 moves and the noon rule, and so that makes it hard. But all I'm really wanting to point out about this, and I'll stop rambling, is I don't want it to be the takeaway to be from this, all this is what's happening, to kind of be doom and gloom and just be like, oh crap, it's a warning. It should be foreshadowing.
Right.
I think. I mean, I hope that's what people are taking away, is like, now is not the time to put your head in the sand.
No.
Either way, like all in or all out, now's the time to just be paying attention.
Yep.
Right, there's a lot going on.
So, if you go back to the beginning of, actually, Russian invasion of Ukraine was February, so it was a little bit after the top in the market in 2022. But if you went back to that and looked at it and said, okay, this is definitely not a good thing. We know the U.S. and NATO, everybody's going to get involved in this. Oil prices are obviously going to go up. Like that was a given. How and when exactly? Who knows the exact timing, but it was pretty painfully clear that energy was going to go up that year. And so you could have said, as far as TSP goes, I'm out. Like there's and inflation was already a big problem. You could have looked at it and said, I'm out. And you would have no reason from a macroeconomic perspective or inflation or anything else, any reason to have gotten back into the stock funds since you got out at the top, or and say when Russia invaded, say in February of last year. There was no indication in anything going on in the world that now is a good time to get back in the stock funds, except NVIDIA explodes to the upside, and you got the big 7 that take the S&P 500 up. We haven't exceeded new highs, but the S&P 500 is going up. So if you're looking at the price charts, you make decisions based on that. If you're looking at what's going on in the world and macroeconomic stuff, you can make decisions based on that. You kind of need to blend the two. You need to be aware of what's going on and look at what the reality of price is doing. Otherwise, you would have missed out completely on the 2023 gains. And again, there's nothing wrong with that, because if you had sat in the G fund the whole time, for the year, you're probably going to get about 5% with zero risk. So there's a lot of things to consider, and it all does come back down to your personal circumstances and risk tolerance, because there is no right answer to any of this. All right. So here's a question we got. Calculating gain or loss. If I left the C fund at a particular unit price, should I wait until that price returns until I buy back in? I never hear unit price in your presentation. Why? So this is something that we have pinned to the Facebook group. I think on the page too. I can't remember, but it's definitely pinned on the Facebook group. And we have a couple of videos pinned up there, and one of them talks about this idea of I think it's in the fallacy of a paper loss, but it might be in the other one. There's a couple ways that you can look at how to think through, because what it really is a way to think through how you're managing your TSP. If you have if you buy a share of stock, you actually own a share of that stock. You can hold it, put it aside, hold it, and it goes up or down in value or whatever. But you
actually own a piece. You own a piece of the company.
Yeah,
that's the real point.
Right. If you buy a share, because the C fund, the way they have it described at the TSP site, you would almost think that you're buying a share of a thing. And that thing has a certain price, which, because they tell you every day, the unit price, which is what this question was, the unit price of the C fund. You don't actually own a thing. It's a number on a spreadsheet. It doesn't mean anything. You don't own anything. And so you can look at it as, I'm accumulating shares in the C fund. That's thinking that that you are owning a thing, and you're trying to accumulate shares of the C fund. And so every 2 weeks you get your payday. You contribute to TSP, and say you have all your contributions going to the C fund. You're buying shares of the C fund, and you're buying, as you know, if you're contributing $1,000 a pay period, you're buying more shares when the market is lower, or when the price of the C fund is lower. You're buying fewer shares when the price of the C fund is higher, and that's what they call dollar cost averaging. But because you're contributing the same amount of money every payday, and you're getting more or fewer shares, right? And so people think that at the end, the more shares that I have, the better off I'm going to be, right? So don't ever sell my shares, because I own these shares, right?
Yep.
What you actually have is an account that is the actual dollar value of your account, right? So your TSP account, say you have $1 million in it. It's made up of all these different shares, or it can be broken down by all these different shares. But essentially, you have an account that's worth $1 million. How you distribute it in there between the CS, I, and F, and G, what those funds do on a daily basis is going to make your overall account go up and down. So
that's the really only asset you have is your account balance.
Your account balance.
The only thing you own is your account balance. You don't own anything else.
Right.
I know it's hard to wrap your head around. And I used to tell myself, like, the only value in my account is my account balance.
Yeah.
And so that's where I put my value, right? And I think to myself, okay, is my account balance going down or up or staying the same? And that is impacted by where I have my money distributed.
Yep.
Right. And so that helped me. I don't know if that's the right way to explain it, but it helped me just realize, how is my bucket distributed? Right. You know, where do I have things? And is that going up and down? And is it going down less? It may be going down, but less faster than it could otherwise.
Sure.
Right.
Sure.
There's, it's not always going to stay the same and go up. That
Right.
doesn't always work that way. Right. But yeah, you don't own any of this stuff. You don't own, if you own a piece of a company, and the company's value goes up for whatever reason, however you want to value it, if it goes up, theoretically, you own something more valuable now. Right. It's worth more. The price is higher. It doesn't work that way in the TSP.
No. So if we look at it on a chart, it's a little bit easier for me to explain things in terms of a chart, and hopefully this is helpful. But let's say back here at the top in 2000. Okay, you had 1,000 or 100. Let's see, 1,000 is a million, right? You had 1,000 shares of the C fund, and each share was worth $1,000. Right. So you had 1,000 shares. Each one's worth $1,000, so you have an account balance of $1 million. Okay? You have 1,000 shares. Each share is $1,000. And I have this in percentages. Okay? So you have 1,000 shares up here. If the market goes down, if the price of the share goes down 50%, right? This is a 50% decline from the top in 2000 to the bottom in 2003. You still have your 1,000 shares. Each share is now worth $500. So your $1 million account value is now $500,000 down here. Okay? When the bottom comes in and price starts moving higher again, the value of your individual shares is going up. You still have 1,000 shares, right? Now, we're not talking about every 2 weeks you're contributing. This is just your core TSP. So you have 1,000 shares all the way along through here. But the value of each share is declining here, and the value of each share is going up here. So at the end of the day, if you ride this whole thing through, you still have 1,000 shares. At the bottom in 2003, those 1,000 shares were worth $500,000. When you get back up to the top again in 2007, they're worth $1 million again. If you held on and wrote it down, this was actually a 55% decline, so somewhere, below 500,000, you were 400 and whatever thousand down here. And then by 2013, you were back up to $1 million again. So the share price is kind of pointless. It doesn't matter what the price of the share is or how many shares. You're not trying to collect shares makes no sense. If you did a really simple trend line analysis of this thing, okay, you have $1 million in TSP up here, and you're in the C fund. If I don't go back far enough, but you break this trend line to the downside, and you say, "I'm getting out. I'm going to the G fund." So you were at 0% here. Say you were down, what is this? You were down 7%. No, 4 or 5. You were down, let's say 5% when you got out from the high, right? You had quote unquote lost 5% right here. But now you're out. So you've saved yourself this whole decline, right? So say you're $1 million. When you got out right here, 5%, 995,000. Is that right? Is that 5%? Whatever it is, you're 5% here, right? You're in the G fund. Let's assume the G fund makes no gains. So you still have your $1 million minus 5% down here. We drew this trend line. If you got back here when it got back up above that trend line, you didn't get all the gains that you would have here from the bottom, but you got a 40% move back up to the top, right? So did you do the numbers? A million times.
No, I mean, it's just 50,000. So you got 950.
Okay, all right, you get 950.
You got 950.
So you do 950 times, 1.4, because you've gained 40% here, right? If you get back into the C fund here, you've gained 40%, and so now your $1 million is whatever it is, basically 1.3 million at this point.
Yeah, you're like at 1.38, something like that. Yeah. So I'm hoping that we've done that kind of walkthrough a few times.
Yeah.
And I think when it sinks in, when people get that, what we just did there, what you just did, I think it all starts to make a lot more sense as to how at least we approach this.
Yeah.
Because the most important thing to use as a performance indicator is your balance, right? Yep. Now, as Jerry just pointed out in that chart, it would be very difficult to get out there at the top. I don't know why you would have a reason to.
No reason.
You really only would have a reason once the trend changed, and you got out. Okay, I lost $5,000. I lost $5,000. I lost 5% of my account.
Yep.
If that's your come from, if your come from is I lost 5% of my account, you're gonna struggle with managing this in any way.
Yep.
If you think to yourself, I saved myself 45%.
Yeah, I saved myself this
Right?
whole move down.
I saved myself 45%, and then I do my best to get back in when the trend changes again. And hopefully this makes sense. It's not really about in this particular circumstance, it's not just about the account value, like us showing you that, you'd start out with $1 million, and if you did it this way, you'd come out with 1.3 million. That is important. What's more important is understanding how and when to accept loss.
Yep.
Right? The risk reward ratios that we talk about all the time. Sometimes there's a lot bigger risk. If you look at this chart, there are times in there where you probably could take advantage of some of those ups and downs, right? But we're not even taking that into consideration. Let's just say you're being as passively active as you possibly can.
Right.
Think about how much impact that would have over those many years, and how positive that impact would be. Not focusing on like, oh my gosh, at these given times I lost 5% or 7% or something like that. If that's how you're focusing on it, you're going to drive yourself crazy, because there's no way to not take those losses other than guessing. And great. And some people do get good at guessing.
Sure.
And it happens, right? And good for them. I'm happy for them, but it's not something it's not a way to make a plan, to execute a plan. But anyway, back to kind of the explanation, right?
Hopefully to the question, and all we did was a chart of the C fund, but there's no value in trying to accumulate shares of the C fund.
Buy them cheap.
Yeah, I mean that.
There's another video that's all part of those ones that are kind of pinned to the top of the Facebook page. If you go in there to the Facebook group, I'm sorry, and look at a couple that Jerry did, the fallacy of a paper loss, and I can't remember the name of the other one, but they both kind of touch on different versions of what we're talking about, which is you gotta stop thinking about this like a brokerage account and like buying actual shares and all of that. They constructed the TSP so that it made sense to us, but that's why we have to have share prices. Otherwise, how would they calculate all of this stuff?
Yeah, you couldn't trade it if you didn't have share price.
Yeah, you have to figure out some way of calculating this. But like Jerry said, all this is just math on an Excel spreadsheet for them even.
Yeah.
This is not buying and selling shares. There's no value in that. There's no asset that you're buying. All you're really trying to do is put your bucket of money in your money in the right bucket at the right time, or distribute it across several buckets. So that you can grow your account balance or preserve your capital. Right. That's another thing too that a lot of people don't put enough weight into, is preservation sometimes is just as important, maybe more important than trying to grow your balance.
Yes. Well, if you go back to the chart, that's what that is, right? If you break the trend line to the downside, you accept this 5% loss, you've preserved your capital through here. Imagine if you were retired, you have your $1 million at the top there, and you're getting ready to retire. You go to the G fund. You might be annoyed that you have this 5% loss. You go to the G fund, and you've saved yourself a 45% drawdown. Now, if you're just starting your career and you have this drawdown, that's one thing. If you're retired,
I still don't want it in the beginning of my career, but I certainly don't want it at the end.
Right. I mean, if you're retired up here, and you're drawing from TSP to supplement your pension, if you're drawing from TSP and the market is going down, so the value of your account is going down, if you were still 100% in the C fund, you get down here, now you have $500,000 minus the amount that's been coming out every month. Right. You could run out of money.
Yeah. And it's not going to grow as fast as it's on the way up because there's not as much in there. Right. And it eerily enough, we're talking about like a 5% drawdown right now in this example. It sounds very familiar to where we could potentially be at right now.
Sure.
Right. So a lot of people, not just you guys listen to this in TSP. I just mean in general, right? In the market right now, are really focused on maybe being down 5-7%, whatever their situation is, right, but completely losing track of the fact that what you're really trying to do is get out of the market when it hits, if we're looking at another huge downturn, right, let's say it's only 20% or 30%, you still don't want to make that kind of, we're not talking, the potential here is 50%, right? If you look at the historical values and where it could go and how far down it could go, and if you say to yourself, "Oh, that's not going to happen," I mean, it's right there. It did happen twice in our
it'll happen
careers.
again.
It happened twice. It absolutely, positively can happen again, and it's highly likely, highly probable right now that that's the direction we're going. Hopefully it isn't as deep and painful as that. But anyway, the point here is this is very possible, and the only way to manage through this is to not be in the market when it does that. And concentrating on share price is not going to get you there.
Right.
You got to focus on your account balance and how to distribute and allocate your money, which I think is the thing you're going to touch on next.
Yeah, we're going to go to it next. Actually, that was a really important thing you just said. If your focus is on the share price of the funds, how can you possibly have any perspective of price movement up and down in terms of the chart? It wouldn't make any sense, right? You'd have to, I guess, get out, because the C fund tracks the S&P 500, but there is no ticker symbol for the C fund itself. So how would you track the what they call it, the unit price of the C fund? You can't do it. You have to make up your own, do it on a spreadsheet. Or
I was going to say, you could do it old school like you used to, right? Yeah. You'd have to do your own chart. You'd have to literally draw it out and say, okay, this is what the C fund looks like. Yeah. And that's not a lot of value.
Essentially you're doing that with the S&P 500. Like that's what the chart does for you. It's really, now that I think about it, it really kind of answers that question. Like, why don't we talk about the unit price? I mean, we do. The unit price is tracks the S&P 500, right? So if the S&P 500 is at 4,400 today, that tracks to a number on the C fund, and that's what that unit price is. And as that goes up and down, you're watching it on a chart of the S&P 500. Anyway, hopefully that helps. If not, definitely go back and take a look at those two videos that are pinned on the group. Right, and so this actually goes to another piece, same kind of idea. I understand the typical purchase of each TSP stock fund is to be spread out across each fund. Let's say you're invested equally in each stock fund, and the S fund's technical analysis indicates it's time to sell. Do you ever move back to the G fund from one fund? Okay, so a lot of times we will be, if we're in the Grow Model portfolio, right, we will be evenly distributed between the three stock funds if the overall market is moving higher, because it's very difficult on any given day or week to tell which of the three stock funds is going to move higher than the other ones, right? So could you, you're equally invested in the stock funds, and the S fund gives you a reason to sell it. Do you ever move back to the G from just one fund? You could. The problem is that you only get 2 moves a month. And so if you use one of those 2 moves to reallocate from only one fund, now you've only got one move that you could move back into the stock funds, and it becomes very difficult. And yes, if we were in a brokerage account, 1,000% you could do that. It's difficult to do in TSP, and I'm not sure that there's much value there. But what the question I kind of wanted to go to on it is where do you want to be, and how do you want to be distributed between the funds? Okay, so let's say we go back to, I think I did this because the I fund began back here in 2001. So you got the I fund in blue, the C fund in black, and the S fund in orange. Okay, so again, this is a percentage scale, so they're the zero is right here. Okay, so going forward from whatever that date is in 2021, going forward, this is the percentage gain over time on each of those funds. Okay, so a couple things to point out on a high level. When the funds go down together, they go up together, they go down together, up together, down together. Okay, that's generally why we are evenly distributed between the three stock funds when the overall market's going up, because in general they go up and down together. Okay, they obviously don't always go up and down together, right? Over time, from 2001, the S fund got up here as high as almost 560% gains, right? The C fund at its high was only, say 300%. So the S fund over time absolutely crushed the C fund, right? Going all the way back to 2001. Okay. Within there are times when, here from 2003 to the top in 2007, the I fund performed the best. Then the S fund, and the C fund was way down here, right? Once we got really here in 2014, we had a big split between the C and the I. The C fund kept moving higher. The I fund hasn't gone anywhere. Okay. But again, in general, they all go up and down together. How are you going to make the distinction in here, for example, that you wanted to go S fund? Because the S fund obviously started moving higher, and the C and I were moving higher together, but not as quickly up as the S fund did. There's no good way to do it. Okay, that's what it looks like on the long term. If you only go back to COVID, so this is the same chart, but just going back to the bottom after COVID, the S fund absolutely exploded right into the beginning of 2021. Way outperformed the C and the I. Okay, you got a 140% from the bottom of COVID. The S fund did 140% move. So if you were 100% S fund, you were killing it, right? If you were evenly distributed between the CS and I, you were somewhere in here. So maybe you were, somewhere under 100%. How could you possibly have picked, if you were going to pick one of the three, how would you have picked the S? Right? It doesn't make sense. I don't know how you would have done it. The S fund eventually topped out, and it came down much harder than the C fund did, or the I fund. So if you were in the S fund here, during 2022, you took much bigger losses than you did on the C fund. So hopefully all this goes to the idea of why we evenly distribute between the three stock funds in general.
Yeah, and it's not because we think that's going to work the best. It's the best you can do.
Yeah.
Because you can't guess. I mean, you can guess. Obviously, you can guess. And you'd have to be willing to take those rides along the way if you chose any of those three. Let's just say you got lucky and you said, you know what, for whatever reason, I think the S fund is going to be the way to go.
Yep.
For my entire career. You probably would have fared very well. But there are going to be times when you would have lost so much money at waiting to come back that you probably would have cried at your desk.
Yep.
And we've seen it. I know people that sat and did that. And so that's what we're trying to keep from happening, is those big, huge swings. Particularly the huge swings actually makes it easier for us to manage our account.
Yep.
Right now, the problem we have mostly is that the market's generally going sideways. When this backs out, we get 3 or 4 years down the road, we're going to look at this point in time, and it's going to look like this. Yep. It's just going to be a correction. It's just sitting there. And that is the hardest time to play any game, anything in the TSP because of the restrictions, right? Because 2 moves a month, noon rule. It makes it so very difficult to do the market when it's just kind of bouncing. Yep. If it's moving up and moving down and slow, that makes it way easier because we just can't react to the market the way we can in other places.
No, that was actually exactly the chart here. I mean, we had a pretty direct move down 50% and a pretty direct move back up and a huge move down. So clearly you didn't, if you did a very simple trend line analysis, and Elliott waves for the 2008. I mean, this was a 1, 2, 3, 4, 5. Couldn't be any more clear. It's almost as clear as the F fund is right now. Anyway, so the last thing I wanted to do about this one was this. If you do actually want to figure out which of the 3 stock funds you want to be in relative to the other 2, so you want to be in the one that's going to outperform. The black line is the S&P divided by the S fund. So the C fund divided by the S fund. So that means that C fund is in the numerator, right? S fund's in the denominator. So when the line is going down, it means the C fund is underperforming the S fund. Okay? When the line is going up, it means the C fund is outperforming the S fund. So there's a couple things you got to keep in mind about this. In this part of the chart, the S fund is outperforming, right? Because the S fund's on the denominator. So when the line's going down, the S fund is outperforming the C fund. So in orange, I have the actual chart of the C fund. And this is important because if the S fund is outperforming the C fund, but the C fund is going down, the S fund, it just means the S fund isn't going down as much as the C fund. And so you don't want to be in either one of them. But in this case, at least for this part of the chart, the C fund is going up. And the S fund is outperforming the C fund. So we know that during this time period, A, the market's going up, so we want to be in it. And B, S fund is outperforming the C fund, so you want to be in the S fund. Okay, that's how you would figure that out. If the overall market's going up and the S fund is outperforming the C fund, then you want to be in the S fund. Okay. On this part, here's 2022, right? The big collapse. What happens? The C fund is obviously going down. The market's in a downtrend. Also, the C fund is outperforming the S fund, right? Because when the line's going up, when the relative strength line is going up, the C fund is outperforming the S fund. So if the C fund is going down like this, and it's outperforming the S fund, imagine how much the S fund is going down over that time period. Okay? So you can't only look at the relative strength chart. You can't only look at this one and say, well, the S is outperforming, or the C is outperforming the S, so I want to be in the C. No. The C is tanking.
It's just tanking less.
It's just tanking less.
Yeah. That's the important takeaway. I mean, that's why we don't just look at one chart or one thing. You know, you have to look at all of these. You don't have to. You don't have to. Let me back up. It's to just generally manage your account. We talk about that all the time. You could use a couple of trend lines, a weekly moving average. Pick one that speaks to you, 20 week, 200 week, whatever it is, right? And basically make your decisions once a week and move on with your life.
Yep. And
that is usually what we recommend to most people unless you have more time to do this, you know, and you want to be more active because you can take a more advantage of certain trends if you do that.
Yep.
But all things considered, you can manage this weekly and everything be fine. And you don't have to go looking at all these other things that we show. Now, if you want to get the max out of it that you can, the only way to do that is to look through all these other indicators. You know, that chart that Jerry was showing you. I mean, you know, we use charts like that to help us decide whether to be in the C or the S. Now, still, at the same time, we're going with probabilities here. We don't know anything. Yep. You know, that chart's great because we know what happened. You didn't know when it was happening, right? You just know, if you go back to the chart, you just know when the trend was changing. So like Jerry pointed out, you saw the C fund obviously did a change. It started going down. That is very obvious if you drew a channel, right?
This one.
Yeah. If you drew a channel in those places, boom, that's as bright as day, right? The trend changed. And you just happen to take a minute to go look at the relative strength of the two, and you say to yourself, oh, you know, the C is outperforming the S, and the C's taken. That means I don't want to be in either one of them. Right. That's when I'm going to G.
Right.
And maybe you check out I or whatever, right. But you get the point. That's kind of how that's like the more to the story kind of thing, right? Yeah. That's going a little bit deeper. And if you understand this concept, that's really not that much more difficult than looking at the other three charts, the right. CS&I with a couple of moving averages or whatever. Right.
So we just did the decline in 22, but the rise in 23. So if we do this channel for 23, the market is moving higher, right? And the C is outperforming the S.
So question would be, if you're listening to this, you know, before we give the answer, where do you think you should be? If the C is outperforming the S and the C is trending up, which one should you be in? I mean, I hope it's obvious, right? It probably is obvious with us talking about it, but it probably wouldn't be obvious if you were trying to figure this out on your own.
It wouldn't be, but you have to have that relative strength chart.
Yeah,
Otherwise, you can't
wouldn't
tell.
know. Yeah, and so that tells you the overall market's going up. Great, the trend is up, and the C is beating the S. So I'm probably not going to be in C and S. I might just be in C. That's where it starts splitting hairs, right?
Yep.
That's where it starts splitting hairs, and that's why we tend to not split hairs, right? I mean, if you go historically back through our allocations throughout the years, and you can go look them, they're on the website, they're public, the previous ones, not the current one, but you'll see that there are many times throughout the years we're pretty much evenly distributed among the stock funds because there's no indication as to which one is beating the other,
Right.
Until after it's happened,
Yeah.
And now if it's a clear indication through relative strength that that's happening, that's when you'll see us in one.
Yep.
But
It doesn't happen very often, but yeah.
Yeah, it does. It happens less often than evenly distributed. And this time frame is kind of one of those times, right? I mean, in at least the last few, we haven't been evenly distributed between all three, And then of course it was 2018 where we were all F.
Yeah, we're gonna get to that in a second.
All right.
All right. So hopefully that helps give you guys some ideas, at least how to think about allocation percentages. All right, TAN. So I know we got a bunch of people that kind of watch the show and have brokerage accounts, and I'm not saying you should buy TAN or not buy TAN, but this is the Invesco Solar ETF.
Yeah, it's just a good learning tool.
It's a learning tool. That's all this is. So if you remember, I didn't realize it was so far back in the day, but solar, really in when the Biden administration, I guess, came in, what was that, 2020, right? So there's where we were in solar in 2020, and we had a big spike up, going on this idea of renewable energy. But way back here in 2008 is when the ETF was first created. It was up here at $300 or so a share. It promptly tanked down to $60 a share. Had a recovery here, an ABC correction down to a final bottom at $12.63 a share. Okay, in 2012. So if you do a Fibonacci tool from the all-time low, okay, at $12.63, up to the most recent high, the beginning of 2021, at 125.84. We are back down. So the black line was the initial move down from the top, but I did the Fibonacci tool from the actual final low. So we are right now, basically right at the bottom of that first move down, okay? And it went through here as a resistance level, here as a resistance level, broke back above it here, came all the way back down, and we're back to that line right now. Okay, so I'm just pointing it out. It's very likely this is the 786 retracement level. Anywhere in here would be a really good place for a bottom in the TAN ETF. Okay, if you drilled in a little bit closer, so now we're 2019, we're just looking at that last, so here's the big run up. Since that big run up, we have, so this first move down in that black line, okay, if you clone that black line and move it over, you get this black line. And that's basically where we're just above it right now. So this is A, ABC for B, A, B, and this is going to be the C. So you've got an A, B, C correction. As long as we stay above, I would say, that level, this thing has a potential to absolutely explode to the upside. So it's obviously on my radar, but the more things that overlap, the more important it is. And we're talking about a weekly chart. So, if it's at I don't know where it's at today, but let's say it's 50. If it goes back to 100, that's 100% on your money, and you're not even close to the all-time highs up here. So it's, I don't know if solar catches a bid, but if it does, TAN is looking like a pretty good ETF to go with. But again, it's a learning tool. That was the point of doing that. Okay, TSP fund charts. Again, it's weekly chart. 20-week moving average line. Here's the biggest takeaway for this. When the 20-week moving average line is on an incline, okay, you have all this movement around of price, but as long as the moving average over 20 weeks is moving up, you're in good shape. When the moving average line starts moving down, that's when you have problems. Okay. The moving average, 20-week moving average line, when it's moving up, it's acting as support. Okay. When it's moving down, it's acting as resistance. Right? So you want to be in the C fund in this case when price is above a rising 20-week moving average line. And you want to be out when price is below a falling 20-week moving average line. And so the hard part is trying to figure out the transition, right? When it goes flat and sideways like that, it's very, very difficult. That's what Colin was talking about before. It's very difficult when we're in this flat movement, because once price is above the 20-week moving average line, right? That's where you're getting these big bull runs. So here, for example, if you got back into the stock funds here based on this, price is now above the 20-week, so it either goes this way or it goes down, right? And in this case, it came down to new lows. You're going to get the same thing up here. We've got 4 weeks below that 20-week moving average line. The moving average line is starting to roll over. It's clearly acting as resistance now. So it's not a great time to be in the C fund, right? If it's goes sideways like this, it's going to be very frustrating if you're going in and out. But the idea is to catch. Once it gets above there, at some point, you're in a new bull market, and you're in and out until that happens. If you're using this methodology, S fund. This is even honestly worse. We're in this bearish triangle right now. And we're pretty clearly broken to the downside of it. So we're not only 1, 2, 3, 4, 5 weeks below that 20-week moving average line, but a bearish triangle, you have a move down, A, B, C, D, E. This decline should be the same length as that decline. S fund is looking very, very spooky right now. I fund is actually a great example of a 20-week moving average line. So once we got back above it back here, if you stayed in as the line was positive, you had one whipsaw right there in September of last year, or 2020 actually. But it did a really good job of hitting resistance. Never got back above it, right? That 20-week is really good resistance until we get above it right there. And that was clearly a great time to get in. And then again, we had one whipsaw week here. And so once we got below that 20-week moving average line here, we haven't been able to get back above it again, right? This is a really, really good example of a chart. I mean, there's no reason to be in the I fund anywhere in there. Once we had that down week right there, you don't want to be in it. And the F fund, this is unbelievable, and it's got the most potential. So this was the beginning. Remember the dinosaur dude? That's the beginning of the ETF. So this was a huge move down in 2008. We're almost back down to those levels now. I mean, this has been, we're going to close out this year with a 3 consecutive down years in bonds. It's never happened in the history of the United States. And so And we've done it in a very clear 1, 2, 3, 4, 5 pattern. At some point, we're going to get a monster recovery rally out of this. Whenever this 5 wave is complete and we start ticking up the other side, we're going to get a monster recovery rally out of here. And given all the macroeconomic stuff we talked about in the beginning, this is the highest probability trade of making money that we have going forward for some significant amount of time, I would say. I mean, my opinion is we're at a top in a long-term top in stocks, and we clearly are at a long-term historic bottom in bonds. Not to say that bonds can't continue to fall, but and it's been a very rough 3 years for bonds. Okay, so that's basically the highlights. If you guys want, the day-to-day kind of market stuff, we do the weekly newsletters, special updates, and the real-time change notifications on the Grow Model portfolio. Sign up at growmytsp.com. Questions?
If you have questions, shoot them our way in the comment section wherever you find the video. If you don't have a comment section wherever you find the video, shoot us an email. The support team will get it to us, support@growmytsp.com.
The questions help. Obviously, we've been doing them here for the last few weeks, and hopefully people, it tells you where everybody else, what everybody else is thinking, and B, they tend to be good questions, and so hopefully this helps.
All right, guys, have a great week, and we will see you next time.
Out of here.